All right. How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, we're going to be looking at the FDIC's third quarter banking profile report. How has the banking industry been doing so far? How are community banks performing? How is what's called the Deposit Insurance Fund performing? So we're going to take a look at two things today. We're going to look at a blog post from PCBB, which is basically going to go through some of the highlights of the report. And then we're going to take a quick look at the report itself. So let's bring this up. So start with the PCBB blog post, which is called FDIC third quarter data, good times for small banks, but will they last? And it starts out by saying, in Louisiana, with its French roots, they have a saying that dates back to the 1940s, laissez les bons temps rouler. That translation, let the good times roll. It could be an apt motto for community banks at the moment. Community banks are enjoying a favorable financial tailwind that has given them an edge. Community banks saw improved results in the third quarter of 2024, including higher net interest income and higher net operating revenue. There were also no community bank failures in the third quarter. In fact, things have been going so well that small banks outperformed the industry as a whole in several key areas. So then it goes on to say promising third quarter results. Each quarter, they review the FDIC's banking profile. Here are some key takeaways for community banks as a group. So net income increased. So net income hit $6.9 billion for the quarter, up 463 million, which is 6.7% from the previous quarter and 3.9% from the third quarter in 2023. More than 58% of community banks reported a quarter-over-quarter net income increase. By comparison, the banking industry as a whole saw third quarter 2024 net income decline by 6.2 billion or 8.6% from the previous quarter. However, that drop in income for the industry was mostly due to an unusually high income level for the second quarter, which saw a windfall 10 billion gain on equity transactions for certain banks. Now, going on to the next thing, net interest income and net interest margins improved. So net interest income rose 574 million or 2.7% from the previous quarter. The banking sector as a whole saw improved net interest income and margins, but again, community banks performed slightly better than the aggregate in one key metric. While the banking industry saw net interest margins rise to 3.23%, community banks' net interest margin increased by 6 basis points to 3.35%, thanks to rising yields on earning assets. Now, just so you know, it's kind of an interesting, as kind of an industry benchmark, you're basically looking for a net interest margin of 3%, like 3% or better. That's kind of the standard of what you're looking for. So if you're at 3.23 to 3.35%, not doing too bad. You'd love to see it maybe more at 4, but again, anything over 3, not doing too bad. Net operating revenue rose. So net operating revenue, net interest income plus non-interest income increased 622 million or 2.4% in the third quarter. By contrast, industry net operating revenue rose a scant 0.3%, dragged down by a decrease in non-interest income. So unrealized losses dropped. So unrealized losses on securities fell 27.3% from the previous quarter and 47% from a year ago. Rates on long-term securities like 30-year mortgages and 10-year treasury notes declined during the quarter, and that helped boost the value of those securities already held. The industry as a whole did well here too, with unrealized losses down 29%. However, I would put a big caveat on this because, as we know, from fourth quarter numbers and what we're seeing so far here in just the early January part of this year, that trend has kind of reversed itself a little bit with interest rates and yields going back up. I'll put it this way, there was a window there for banks if they wanted to, kind of sell out of things, and it's still, and remember, importantly, still at a loss. But if they wanted to sell out of things and not perhaps take as much of a hit, that was the window for them to basically do that, to basically what they call reposition the bond portfolio or reposition the investment portfolio, whichever you prefer on that. but there was a window there, and now we know that window has kind of closed a little bit. And even though things improved there, it's still a major issue for the industry. I mean, just take Bank of America is the biggest case. Bank of America is potentially looking at like $110 billion loss, which is just enormous on their unrealized bond losses. So it's still a big problem in the industry. Securities improvements boosted income. The securities turnaround did wonders for CFI income. In the third quarter of 24, CFIs recorded an income gain of $79 million on securities. In the third quarter of 2023, they suffered a loss of $388 million. And then charge-off ratio is better than the industry average. One area to keep an eye on is the charge-off ratio, which rose 2 basis points from the previous quarter and is up 4 basis points year over year. But the ratio now stands at 0.16%, which is 1 basis point higher than the pre-pandemic average of 0.15%. Still, community banks are faring better than the banking industry as a whole, although the industry net charge-off ratio fell 1 basis point in the third quarter at 0.67%. It's still up 16 basis points year over year and 19 basis points above the pre-pandemic average. So charge-offs for community banks are looking very good at the moment. And as I reported before, the big issue there is more with the large, the big four banks, and then a lot of your regional banks. They're the ones that have the big mortgages on the office buildings that are in the downtown urban areas. That's the one of the big issues at the moment. But they're also the ones they have the big mortgages on everything, whether it's big apartment complexes or million square foot industrial buildings. That's all with the bigger banks and bigger regional banks. And so it's not shocking to me that community banks are basically doing better in this area because they've got smaller commercial real estate, which is hanging in and performing very well. Okay, and then this just wraps up by saying, hey, predicting the financial future is always tricky, but early readings point toward a continued positive outlook well into 2025. Community banks posted solid results in the third quarter, often outperforming the industry as a whole. That trend may continue well into 2025. Yes, but I would also add a caveat that we already know that these numbers were not as good in the fourth quarter. Profitability and net interest income, net interest margins came down a little bit in the fourth quarter. Delinquency probably ticked up a little bit. Like I said, the unrealized losses kind of reversed itself a little bit, but overall, not doing too bad, not performing too bad. But like I said, we already kind of know. I could kind of spoil the surprise when we get in another month or so when we get the FDIC's fourth quarter banking profile for 2024. We already know that the numbers won't be quite as good. Things won't be quite as rosy, but still performing fine and still performing okay. So now, so here's the report itself. This is like I said, this is the FDIC quarterly banking profile. And basically, this report breaks down into 3 sections. You've got banking overall, then it goes to community banks, and then it goes down to the deposit insurance fund. So we can see here for insured institutions, net income decreased from the prior quarter, driven by one-time items. Net interest income increased as the net interest margin rose across all size groups in the quarterly banking profile. Asset quality metrics remained generally favorable, though weakness in certain portfolios persisted. Loan balances increased modestly from the prior quarter and a year earlier. Domestic deposits increased from the prior quarter, driven by higher uninsured deposits, and the deposit insurance fund reserve ratio increased 4 basis points to 1.25%. So, and again, that's for the industry overall. And then you kind of go down here scroll down a few pages. And it goes through all this. This is a great report. This is actually one of the reports I really actually enjoy looking at because it's just very nicely put together, very nicely broken down by the FDIC. And then we get down here. Now we get into the community bank performance, which we already went through. And then we're going to scroll down a few more pages to go just to the last thing real quick, which was the deposit insurance fund. I just want to scroll down to that. Okay, so insurance fund indicators. Deposit insurance fund increased by $3.9 billion. the DIF, it's called the Deposit Insurance Fund, also we call it the DIF. DIF reserve ratio rises 4 basis points, ends the third quarter at 1.25%. No institutions failed during the third quarter. So during the third quarter, the DIF balance increased by $3.9 billion to $133 billion. The rise in the DIF was primarily driven by assessment income of $3.3 billion. Interest earned on securities, negative provisions, and unrealized gains on securities also contributed a combined $1.2 billion to the fund during the quarter. These gains were partially offset by operating expenses of $0.6 billion. No institutions failed during the third quarter. So the Deposit Insurance Fund is doing just fine. Percentage of insured deposits, we can see here from this little chart here going back to September of 21 to September of 2024. And, things have been, holding pretty steady. We saw that dip down, obviously, with the crisis in early March of 2023. And then, the insurance fund has been steadily coming back up. And we could see now we're right back to kind of where we want things to be, right where they were back in September of 21, December of 21. So again, a deposit insurance fund, doing just fine. But like I said, I thought this was a great thing just to kind of cover this report real quick, just to check it out, let people know that, hey, going back to the third quarter, community banks performing pretty well, banking industry overall performing pretty well, deposit insurance fund not doing too bad, kind of right where we want it to be. So, but I will wrap up with that. And basically there are links to the reports that I put down in the descriptions. If you want to go check those out, please do so. But I'll wrap up with saying, if you like this episode, please make sure to like, share, and subscribe, as that really helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other videos on the channel, and I will see everyone again real soon. Thanks.